For more than 6 decades, I've encountered one statement repeatedly above all others. Gold represents the world's most secure investment. Investors claim it maintains its worth, serving as the perfect safeguard. Yet I've dedicated my entire career to observing how this conviction gradually diminishes the wealth of those who placed excessive trust in it. Not through sudden market failures, but through consistent underachievement. That's the element most people overlook. They believe they're securing their future, when in reality, they're clinging to a strategy that's no longer effective. While everything about investing has fundamentally transformed today, panic dominates every corner. Inflation diminishes what money can buy. National obligations continue climbing. Borrowing costs keep climbing higher. Currency strength continues declining. And whenever anxiety dominates, investors flee toward the same solution. They've placed their confidence in, for generations, gold. I comprehend that instinct. It comes naturally. Throughout history, it appeared entirely logical. During periods when financial systems evolved gradually and physical currency dominated, gold provided genuine protection. Yet that era has disappeared. The frameworks that previously empowered gold have vanished. And the contemporary financial landscape doesn't pause for outdated methods to adapt. Now, allow me to clarify something. Gold maintains decorative worth. It's visually stunning, uncommon, and eternally elegant. Yet it's simultaneously among the most poorly comprehended holdings in our current age. Investors regard it as safety, yet it frequently operates more like sentiment, unpredictable, unstable, and unproductive. What's approaching will test the beliefs of those convinced they're exercising prudence. Because in our modern investment landscape, the genuine threat isn't market swings. It's becoming obsolete. And gold is steadily moving in that trajectory. What unfolds next will catch many off guard who assume they've chosen wisely. Yet to comprehend our destination, we must revisit a pivotal moment. During 1971, President Richard Nixon severed the connection between American currency and gold. Immediately, monetary value stopped being quantifiable in weight. It transformed into something measured by confidence. That transformation didn't merely alter financial policy. It fundamentally changed how individuals conceptualized worth, stability, and authority. Prior to that declaration, each unit of currency possessed a tangible foundation. You could connect it to storage facilities, to measurable quantities, to regulations that provided assurance. Yet the instant we abandoned the precious metal standard, that assurance transformed into faith. Currency became conceptual. And predictably, widespread concern emerged. Investors rushed toward gold, expecting perpetual appreciation. For several years, that materialized. Values climbed dramatically. Those possessing gold felt their choices confirmed. They weren't merely market participants. They were navigators of what they perceived as systemic failure. Yet by the beginning of the 1980s, circumstances shifted. Gold ceased functioning as wealth preservation. It evolved into something entirely different, a response to uncertainty. Investors weren't acquiring it for appreciation. They were acquiring it for psychological comfort. And that's where genuine risk emerged. Because throughout every financial catastrophe I've observed, anxiety represents the quickest route to flawed choices. Anxiety distorts reasoning. It causes paralysis while circumstances continue evolving. And no serious investor should construct an approach based on feelings, particularly not one as antiquated as longing for bygone times. Allow me to present something most market participants never properly analyze. Investors label gold protective. Yet protection must function not merely symbolically, but numerically. Had you invested $100 into gold during 1973, you'd possess approximately $6,000 presently. That appears reasonable. Yet figures lacking perspective can mislead. That identical $100 in the S&P 500 with dividends reinvested would currently equal over $20,000. That's not conjecture. That's what patient, steady ownership of functioning enterprises has generated. So what does this reveal? It demonstrates that a gold failed to maintain your buying capacity. It merely decelerated the decline. That's not protection. That's a temporary buffer in a deteriorating situation. It reduces impact, yet it doesn't prevent loss. And here's where the deception intensifies. Gold's deterioration isn't solely about lagging behind equities. That's merely superficial. The fundamental fracture is this. Gold no longer occupies a central position in the framework it previously secured. It's diminishing not from failure, but from being surpassed. Throughout centuries, gold maintained worth because it was limited. Couldn't be produced artificially. It couldn't be replicated. That limitation provided its strength. Yet in contemporary markets, limitation alone proves insufficient. Currently, importance is determined through practical application. And gold doesn't generate. It doesn't produce returns. It doesn't participate in any framework that constructs, expands, or multiplies. What previously represented a foundation of confidence has become an artifact of history. Not because belief disappeared, but because markets no longer require it. In our current financial system, limitation has transformed. It's no longer connected to minerals extracted from beneath the surface. It's now integrated into frameworks that don't depend on location or physical storage. And while some assume I'm discussing Bitcoin, the reality extends further. We're approaching a period where mathematical certainty supersedes physical ownership. Distributed frameworks, decentralized recording systems, digital protocols. These are establishing a new foundation of confidence. Not because they resemble gold, but because they function in ways gold never achieved. They're customizable, unrestricted by borders, confirmable, and most critically, they expand without physical constraints. This transformation isn't hypothetical. It's already occurring beneath surface observations. Gradually, consistently, investment flows not into what remains stationary, but into what circulates. And that's what serious investors must comprehend. Gold might still sparkle, yet the monetary system is gravitating toward holdings that can transform. Annually, we extract approximately 3,000 metric tons of gold. The availability increases gradually, reliably. Yet interest, genuine interest, has stagnated. Ornamental purposes, governmental reserves, manufacturing applications, nothing revolutionary, no significant advancement. Meanwhile, enormous capital flows toward digital frameworks, into sovereign obligations, into innovation-driven enterprises. The distribution of investment has transformed. We are no longer evaluating limitation exclusively. We're evaluating importance, practical function, and systemic integration. And when I mention something devastating approaches for gold, I'm not referencing an immediate failure. I'm referencing something considerably more difficult to detect: a gradual erosion of significance. The variety that doesn't generate attention until circumstances have already shifted. What's occurring with gold isn't obvious. It's not a market failure. It's deterioration. Quiet, continuous, fundamental, like a structure whose base is crumbling from underneath. You don't observe it until suddenly something fractures, and by that point it's irreversible. This isn't about creating alarm. It's about recognition. I'm not attempting to frighten anyone. I'm explaining why traditional wealth protection models no longer align with our current framework. Most investors still respond as previous generations did. A concerning headline, an increase in obligations, an inflationary wave, and they rush toward what previously felt secure. Yet that environment changed long ago. Contemporary markets reward flexibility, not bulk. They favor acceleration, not accumulation. During 1971, security meant something tangible you could possess. In 2025, security is quantified in information movement, operational velocity, and generative capability. The contemporary financial system values innovation, not conservation, concepts that multiply, frameworks that advance, investment that circulates productively. And yet, investors reference central banking institutions and claim they're still acquiring gold. Correct, but don't mistake convention for functionality. Central banking institutions maintain gold the way institutions preserve historical artifacts. It demonstrates continuity, yet it doesn't enhance results. It doesn't create income. It doesn't address risk in an environment characterized by speed. That's the transition most investors haven't recognized. Gold currently is no longer an instrument. It's a symbol. Investors don't maintain it for its function. They maintain it for its representation. It communicates prudence, steadiness, a link to tradition. Yet symbolism doesn't equal returns. And when financial strain intensifies, when available capital diminishes or frameworks restructure, symbols don't safeguard you. Income flow does, returns do, utility surpasses sentiment consistently. And gold, despite its brilliance, has become practically outdated in a framework that's advancing beyond symbolic foundations. Here's something investors seldom recognize. Gold is valued in American currency. It always has been. So when someone acquires gold because they've lost confidence in the dollar, they're still executing that exchange through the precise thing they're attempting to avoid. It's paradoxical. You're not separating from the framework. You're simply protecting within it. That's not autonomy. That's reliance disguised as resistance. And here's where the genuine transformation commences. The instant the worldwide financial system identifies a dependable, distributed, seamless method to preserve worth without gold, without government currency, without centralized reserve assurances, gold's traditional function disappears. Not from failure, but because something more flexible emerged. That's not a failure. That's replacement through advancement. Before we discuss what supersedes gold, allow me to guide you through a straightforward mental exercise. Visualize this. It's the year 2030. The American government introduces a digital currency. It's customizable. It's monitored. It finalizes immediately. Most individuals adopt it because it's rapid, simple, and seamless. They don't question where authority resides. Yet beneath that ease is a power transfer from citizens to organizations. This new monetary form isn't merely currency, it's monitoring. Every exchange, every unit transferred can now be observed, influenced, and limited in real time. And when individuals recognize how much supervision that permits, their natural reaction will activate. They'll grab for gold like they habitually have. Yet this occasion, something's changed. The monetary framework no longer requires tangible holdings to establish confidence. Available capital isn't connected to storage facilities anymore. It's connected to programming. Once digital infrastructure supersedes physical assurances, the foundation supporting gold weakens. It's not a market adjustment. It's a redefinition. And by the moment most individuals perceive it, the transformation will already be finalized. They won't observe announcements. They'll observe quiet. The variety of quiet that accompanies a tradition losing its ultimate purpose gradually, irreversibly. Let's eliminate a hazardous misconception. The misconception of steadiness. Whenever gold increases, media proclaims the identical narrative. Escape to security. Yet if you expand perspective and examine decades, a sequence appears. Gold doesn't increase with advancement. It increases with alarm. Its heights correspond with disruption. Its declines accompany resolution. That reveals something straightforward yet significant. Gold doesn't build wealth. It responds to anxiety. And any holding that depends on human worry for results is not an investment. It's an emotional support. This is why I've never regarded gold as a compounding instrument. It doesn't distribute dividends. It doesn't reinvest. It doesn't transform. It simply waits for circumstances to destabilize. Yet no approach should be constructed on anticipating instability. If you're maintaining gold currently, I'm not attempting to distress you. I'm encouraging perspective. Comprehend what's beneath the valuation. Not merely the graph, but the pattern that generates it. Because when this shift concludes, what investors lose won't merely be currency. It'll be confidence. And when confidence abandons an holding, history demonstrates it seldom returns. I've observed this occur in raw materials, in monetary systems, in complete industries. Silver experienced it. Petroleum did as well. Yet gold's transition will be distinct. Not because another mineral will assume its position, but because something abstract is substituting it. A transition from physical to conceptual, from mass to velocity, from limitation to verification. And that variety of transformation doesn't merely revise valuations, it revises convictions. Now, let's discuss what actually removes the foundation from beneath gold. It's not inflation. It's not central banking. It's not even interest. It's information. Not merely information itself, but how information circulates, how it finalizes, and how it supersedes the requirement for tangible assurances. In an environment where commerce finalizes in fractions of seconds and confirmation is integrated into every exchange, the traditional reasoning for maintaining hard holdings vanishes. You don't require physical contact to establish confidence anymore. You simply require programming, and the assurance that programming can't deceive. That's why gold as a framework can't maintain pace. It's not merely excessively slow. It's isolated. It doesn't integrate. It doesn't respond. The future of worth resides in seamless transfer in holdings that function more like software than substance. And once that transformation is finalized, gold isn't merely antiquated, it's incompatible. That's the circumstance most investors haven't absorbed yet. And if you're still connecting your future to a mineral that doesn't transform, then you're not protecting against risk. You're disregarding evolution. Here's the element most individuals overlook. In current markets, worth is quantified in circulation, not bulk, not brilliance. But velocity, dependability, verification, a preservation of worth is no longer something that remains in storage. It's something that adapts to frameworks that transfer investment, confirm confidence, and multiply utility in real time. Gold can't relay information. It can't create productivity, and it can't engage in the precise systems that are characterizing 21st century finance. And that's where gold reveals its greatest weakness. It doesn't circulate. It doesn't engage. It doesn't multiply. In a period where investment crosses territories at fractions of seconds, and holding secured in storage becomes more than sluggish, it becomes insignificant. Available capital is now characterized by velocity, not mass. By the moment you access physical gold, enormous sums have already transferred elsewhere. The genuine turning point arrives when digital finalization becomes the worldwide benchmark. I'm not merely discussing one innovation. I'm discussing a complete environment, customizable currencies, digitized holdings, and blockchain-based settlement. These instruments don't require emergency reserves like gold. Once these frameworks are trusted, gold's ultimate purpose, crisis psychological protection, gradually disappears. For now, gold still exists in the background as a symbolic protection. Not because it's required, but because it hasn't yet been substituted emotionally, but that's already transforming. Nations like China, India, and Brazil are testing commerce frameworks that circumvent both gold and the dollar. They're settling in domestic currencies, digital units, even pure recording-based tokens. And once those infrastructure hardens, the emergency protection doesn't merely weaken, it vanishes entirely. When countries begin settling commerce using pure digital records, recording to recording, they're communicating a distinct message. We no longer require storage facilities. Not for finalization, not for confidence. That instant marks a quiet transformation. Gold doesn't fail in drama. It deteriorates in silence. When significance is no longer attributed to mass, but to structure. I'm not claiming gold's valuation vanishes immediately. That's not how worth erodes. The deterioration commences in mindset, in awareness, and then transfers into conduct. It begins subtly. Markets observe inflation climbing, yet gold remains unchanged. Administrations expand their obligations, yet gold doesn't react. That separation constructs uncertainty. Uncertainty expands. Portfolio managers begin redistributing. Not from anxiety, but from pragmatism. They transition from inactive minerals to return-creating holdings, instruments that generate holdings that integrate inside a contemporary portfolio. Then one day, the base drops not from alarm, but from disregard. There's no rush to departure. There's no departure remaining. This is what I label quiet desertion. Not a failure, not an announcement, merely a gradual disappearance from awareness. And when a holding gets deserted, not liquidated, but disregarded, that's when it forfeits its ultimate utility. Some of you might state, Warren, investors have anticipated gold's deterioration for decades, yet it's still present. And that's accurate. Yet existing isn't equivalent to flourishing. Continuation doesn't indicate strength. It simply indicates nobody's terminated it yet. Gold currently reminds me of a celebrity from classic cinema. Everyone recognizes the identity. Everyone respects a heritage, but the attention has progressed. It's no longer about what previously was. It's about what still functions. That's the transition occurring now. Gold remains a representation. Correct, but representations don't multiply. They don't expand. And in investing, representation doesn't distribute returns. What supersedes gold isn't another mineral or miraculous token. It's a system, a complete framework of worth that encompasses functioning enterprises, customizable holdings, real-time settlements, and currencies that modify to how individuals exist and exchange. We're transitioning into a multi-dimensional financial system, not constructed on limitation exclusively, but on results, confidence, and flexibility. That encompasses blockchain-based infrastructure, digitized frameworks, and possession in enterprises that generate daily, not sporadically. That's the future of worth preservation. It's not brilliant. It's functional. And functionality is what genuinely creates limitation now because attention and utility are restricted. I recall sitting in a conference room back in 1998. Markets were destabilizing over Asian currency disruption, obligation markets in turbulence. Investors clutched silver, gold, and foreign securities. Someone turned to me and inquired, "Warren, how are you protecting?" I responded, "I'm acquiring enterprises that distribute hamburgers." They laughed. Yet I wasn't jesting. Individuals don't cease consuming during catastrophe. Genuine worth never becomes obsolete. The room paused, yet I intended every statement. Throughout every catastrophe I've experienced, from energy disruptions to property failures, one element has never transformed. Individuals still require sustenance, transportation, and existence. They expend on what maintains them functioning. That's the distinction between holdings that endure and holdings that provide. Gold shelters anxiety. Yet enterprises, genuine functioning, generative enterprises safeguard futures. That's what we should maintain as the environment transitions from tangible limitation to digital utility. Because when utility becomes the fundamental worth, gold doesn't merely lag behind. It vanishes from discussion entirely. Allow me to provide you one final visualization. It's straightforward, but it communicates everything. Central banking institutions worldwide maintain 36,000 metric tons of gold. That's the figure. Yet examine closer. They don't distribute it. They don't profit from it. They don't utilize it to finalize the overwhelming majority of their international commitments. It's not operational investment. It's traditional inventory, preserved worth with no generation. Now, compare that to current financial infrastructure. Enormous capital flows through digital systems daily, not in theory, in returns, in distribution, in immediate settlement frameworks that never cease. One holding circulates, one remains, one transforms every 5 months. The other hasn't transformed in 5,000 years. That's not merely a discrepancy. That's the boundary of a transformation. And most individuals won't perceive it until it's already surpassed them. Now, let's finalize this. If you're preparing for retirement, administering a portfolio, or simply attempting to secure your family's monetary future, you're confronting a new circumstance. The traditional protections, the ones constructed from convention, sentiment, are deteriorating. Yet, this isn't a request for alarm. It's a request for precision. In my experience, when the environment transforms, the intelligent investor doesn't freeze. They adjust deliberately, purposefully. Step 1 is reevaluation. If your portfolio depends excessively on symbolic holdings like gold, begin decreasing involvement. Don't liquidate in anxiety. Modify in understanding. Any position that depends on awareness, not generation, should be reduced. Transition toward things that do function. Enterprises that profit, property that creates income, treasury instruments that return without instability. These are the holdings that operate while you rest and secure you while others respond emotionally. Because protection in the 21st century isn't about remaining unchanged. It's about modifying rapidly. Gold doesn't modify, it remains. Step 2 is learning. The monetary environment is evolving faster than most individuals comprehend. From digitized holdings to central banking digital currencies, the infrastructure is being reconstructed. And this transition isn't an innovation pattern. It's fundamental. You don't require to acquire cryptocurrency to understand where this is progressing. Yet you do require to examine the infrastructure. Currency now circulates on. Comprehend customizable investment. Discover how wealth transfers between systems without territories or banking institutions. The subsequent financial disruption won't inquire who possesses the most gold. It'll inquire who comprehends the framework underneath and who has positioned themselves ahead of it. In this new environment, monetary knowledge is your genuine protection. Not mineral, not traditions. Step 3 is straightforward, yet it's the most powerful. Construct worth nobody can extract from you. That could be an enterprise, a specialized capability, a resolution the environment actually requires. It doesn't remain in storage. It doesn't get diminished by regulation. It can't be taxed into non-existence. Individual generation is immune to inflation. It's invisible but permanent. And it multiplies gradually, consistently, persistently, regardless of what occurs to gold or the currency or borrowing costs or announcements. The capability to generate worth is the one holding no framework can eliminate. That principle has never transformed and never will. Gold had its period. It constructed empires. It supported confidence, but like every framework before it, even gold must surrender to advancement. Not from failure, but because something superior emerged, not heavier, but more intelligent. History always provides indications. Salt was once invaluable. Silver was once revered. Territory was once a monetary form. Yet over time, each of these transitioned from exchange medium to raw material. From confidence to commerce, the transition doesn't occur in announcements. It occurs in silence. As utility diminishes and significance is reassigned, gold is following the identical trajectory. Not because it's defective, but because it's completed its function. Frameworks transform and so do preservations of worth. The hazard isn't a dramatic failure. It's quiet outdatedness, the variety you don't observe until it's already concluded. No drama, no urgent reports, merely indifference. That's when something genuinely terminates. Not when individuals reject it, but when they cease considering it altogether. And that's the destiny gold is moving toward. Not a villain, merely no longer invited to the discussion. Some of you might still be questioning, if the framework becomes completely digital, won't investors flee back to gold for protection? It's a reasonable consideration, but remember, even emergency frameworks transform, the subsequent layer of protection won't be tangible. It'll be computational. Resilience will be programmed, not accumulated. The new redundancy won't be buried in storage facilities. It'll exist in distributed systems, protected layers, duplicated infrastructure. The subsequent protection won't sparkle. But it will operate.